As a rookie investor, we know you have a lot of questions, like how much money do I need, how should I begin, and what are the best investment strategies? We answer these questions and more in this video, so keep watching. After you've managed to budget for your monthly expenses and stashed away some money for emergencies, it's time to consider investing. Here are 5 steps you must take to start investing this year. Even if you're already an investor, you will want to consider these steps. Step 1. Start investing early. One of the best ways to see good returns on your money is to start investing when you were young. This is due to the power of compound interest, where your investment returns begin to generate their own returns. With compounding, your account balance grows exponentially over time. Many people ask whether it is possible to start investing with a little money. You most certainly can. It is easier than it has ever been to invest with small amounts. This is due to low or no investment minimums, commission-free trading, and availability of fractional shares. There are plenty of investment options that cater to small sums of money, like mutual funds, index funds, and exchange-traded funds. Instead of worrying about whether your contribution is sufficient, concentrate on what seems reasonable in light of your circumstances and financial goals. Whether it's $1,000 a month or just $50 a month, the key is to make regular contributions to your investments. Just so you understand how this works, let's suppose you invest $200 per month for 10 years with an average annual return of 6%. After a decade, your investment would have grown to $33,300. Out of this total, $24,200 represents your contributions, those $200 monthly payments, while $9,100 represent the interest you've earned on your investment. Naturally, the stock market experiences fluctuations over time. However, beginning investing when you were young means you have decades to weather those fluctuations and allow your money time to flourish. Don't hesitate to start now, even if you're beginning with small amounts. Step number 2, determine your investment amount. The amount you should invest is contingent upon your financial circumstances, investment objectives, and the time frame for achieving them. A commonly pursued investment goal is saving for retirement, and investing 10 to 15% of your monthly income for retirement is a good rule of thumb. While this might seem challenging initially, you can begin with modest contributions and gradually increase them over time. If your employer offers a 401k or similar retirement account and it comes with matching contributions, your first investing goal is to contribute enough to receive the full match. This is essentially free money, and you don't want to leave any money on the table that gets you closer to your financial goals. For your other investment goals, like buying a house, starting a business, or higher education, consider your timeline and the amount you need. Then figure how much you need to save and invest each month or every week. Step 3. Start an investment account. Even if you're one of the many people who don't have access to a 401k, or other employer-sponsored retirement plans, you can still save for retirement through an individual retirement account, such as a traditional or Roth IRA. Now, if you're investing for a different purpose, you should steer clear of retirement accounts. These accounts are specifically intended for retirement savings and come with certain restrictions on when and how you can withdraw the money. Instead, consider opening a taxable brokerage account, which allows you to withdraw money freely without incurring extra fees or taxes. Since IRA contribution limits typically fall well below those of employer-sponsored retirement plans, brokerage accounts are ideal for investors who have reached the maximum contribution limit for their IRA retirement account but wish to keep investing. Step 4. Choose your investment strategy. Your investment strategy is shaped by your savings goals, the amount of money needed to reach them, and the time frame you've set. If your investing goal is more than 2 decades away, like your retirement, it's advisable to put most of the money in stocks. However, picking individual stocks can be complex and time-intensive. So for most investors, the best approach to investing in stocks is through low-cost stock funds like index funds, mutual funds, and ETFs. When you're saving for a short-term goal with a time frame of less than 5 years, The volatility risk inherent with stocks means that it's best to keep your money secure in low-risk investments, certificate of deposits, or online savings accounts. If you're unable or unwilling to make a decision, consider investing through a robo-advisor. These are services that utilize savvy computer algorithms to construct and manage your investment portfolio. Primarily, robo-advisors build portfolios using low-cost index funds and ETFs and can get you up and investing quickly. Bear in mind, however, that they will generally charge a modest fee of around 0.25% of your account balance to manage your portfolio. Step 5. Explore and know your investment choices. After deciding how to invest, your next step is deciding what to invest in. Choosing the right investment for your portfolio involves understanding the risks and aligning them with your goals. Here are some of the most common investment options. Stocks. A stock represents a portion of ownership in a company. Stock prices vary widely, ranging from just a few dollars to several $1,000s per share, depending on the company's valuation. Bonds. Bonds are basically loans provided to businesses or government entities, repaid in a specified number of years. Throughout this period, you receive interest payments. Bonds are typically less risky than stocks, as they offer a clear repayment schedule and fixed returns. However, bonds yield lower long-term returns, hence, they should constitute only a percentage of your entire investment portfolio. Mutual funds and index funds. A mutual fund is a collection of investment bundled together in a single package. It allows you to bypass the task of selecting individual stocks and bonds by offering a diverse mix in a single purchase. Mutual funds are diversified investments, making them a less risky investment than individual equities. Many mutual funds are professionally managed, but index funds, which are a type of mutual fund, track the performance of a particular stock market index, like the Dow Jones or the S&P 500. Because index funds do not require active management, they can charge lower fees than professionally managed mutual funds. In most 401k plans, there is a selection of mutual or index funds to choose from without any minimum investment requirements. But if you're investing outside of these plans, you may be required to make a minimum initial investment of $500, $1,000, or even more. Exchange-traded funds. ETFs, like mutual funds, bundle multiple investments together. Unlike mutual funds, however, ETFs are traded on stock exchanges throughout the day, just like stocks are, and are bought and sold at a share price. The share price of an ETF typically falls below the investment minimum of mutual funds. This makes ETFs an attractive option for new investors or people on a tight budget. You must also know that index funds can also take the form of ETFs. To begin your investment journey, choose a strategy based on the amount you intend to invest, the deadlines for achieving your investment goals, and the level of risk you're willing to accept. Go ahead, leave us feedback and share your thoughts in the comments. And if you found this information helpful, smash the like button, subscribe to the channel, and share the video with someone who could benefit from it. Until next time, stay financially savvy. We'll see you in the next video.